What if I told you that one of the most powerful tools for building your future wealth is already in your pocket, but you're probably too scared to use it? You're not alone. Today, we're demystifying the stock market. Hello, I'm Mimo, and in the next few minutes, you're going to learn how to start investing, even if you're a complete beginner. We'll cover everything from how to begin with just a little money to building a smart portfolio and avoiding the common emotional traps that lose people money. Let's turn that anxiety into action. Section 1. Start small, think big. The biggest myth is that you need thousands of dollars to start. That's simply not true. Thanks to fractional shares, you can invest in big-name companies like Apple or Tesla for as little as $5. Apps like Fidelity or Robinhood have made the barrier to entry almost zero. The key here is consistency, not the initial amount. Investing just $50 a month might not seem like much, but thanks to compound interest, which Albert Einstein called the eighth wonder of the world, that small habit can grow into a substantial sum over decades. Section 2. Diversification is your best friend. You've heard the saying, don't put all your eggs in one basket. That's the golden rule of investing. Putting all your money into a single stock is like betting everything on one horse. It's incredibly risky. Instead, think about spreading your money across different companies, industries, and even countries. A simple way to do this is through exchange-traded funds, or ETFs. For example, an S&P 500 ETF lets you own a tiny piece of the 500 largest U.S. companies in a single purchase. This drastically reduces your risk. If one company has a bad year, the others in the basket can help cushion the blow. Section 3. Tortoise beats the hare. This is about mindset. The stock market is not a get-rich-quick casino. It's a vehicle for long-term wealth. Look at the data. Despite recessions, wars, and crises, the S&P 500 has historically returned an average of about 10% per year over the past 100 years. That's the power of staying invested. Trying to time the market by buying low and selling high is nearly impossible, even for experts. A far better strategy is tied in the market. Start now, stay invested, and let decades of compounding do the heavy lifting. Section 4. Ignore the noise and emotion. The news is designed to trigger emotion, fear when the market drops, greed when it soars. Emotional decisions are almost always bad decisions. When the market dips, which it inevitably will, your brain screams, "Sell everything!" That's often the worst time to sell. A better approach is to have a plan and stick to it. Consider automating your investments. Set up a monthly transfer from your bank account to your investment app. This practice, called dollar cost averaging, means you buy more shares when prices are low and fewer when they're high, smoothing your entry price over time without you having to stress. Section 5. Knowledge is your power tool. You don't need a finance degree, but you do need to understand the basics of what you're buying. Before you invest in any company, spend 15 minutes researching it. What does it do? Is it profitable? What are its growth prospects? Resources like Yahoo Finance, company annual reports, or even educational videos like this one are great starting points. And remember, if something sounds too good to be true, like a stock tip from a random online forum, it almost always is. Stick to your strategy, not hype. So, let's bring it all together. Starting your investing journey is less about picking the next hot stock and more about building solid, disciplined habits. Begin small, diversify widely, think long-term, control your emotions, and keep learning. The most important step is the first one you take today. If you found this guide helpful, smash that like button. It really helps the channel. Subscribe for more beginner-friendly finance breakdowns, and drop a comment below. What's the first company or ETF you're thinking of researching? I read every single one. Thanks for watching, and I'll see you in the next video.